What's going on, everybody? Welcome to another video. All right, in today's lesson, what I wanted to make sure that I went over with you so that we didn't fall too far behind where we needed to be to try to keep up with this end of semester schedule here is just to pick up where we left off. So last class we were talking about this allowance method that is the GAAP's way of estimating out bad debts at the end of the year, which is just the amount of accounts receivable we think we're not going to get based on that period sales. Remember, as we talked about last class, you have to record this adjusting entry with the allowance method just to make sure that you're following that matching principle, that you're reporting an expense of extending credit in the same period where you showed that revenue of extending credit. All right, so this was the adjusting entry that we looked at last time. The adjusting entry that we record is always a debit to bad debts expense, which is just a normal operating expense, and then a credit to allowance for bad debts, which we saw last class was a contra asset account. Remember, if something is a contra asset account, that means that it's reported with my assets, but it has the effect of bringing the balance of those assets down. So it has the opposite balance of all my other normal assets. As you can see here, this allowance for bad debts has a credit balance. And as I told you guys last time, the allowance method, the reason that these GAAP companies use the allowance method is really twofold. Number one, they do it because they need to make sure they're following that matching principle. They need to record the expense of extending credit with revenues in the same accounting period. Again, that shows a more accurate income statement. Number two, they want to make sure that they report accounts receivable on the balance sheet at an amount that's more accurate. They want to make sure they're showing customers how much they actually expect to collect from those receivables. So by showing accounts receivable less that allowance for bad debts, it's really showing the users of these financial statements how much they actually intend to get. If you look at allowance method and how we disclose accounts receivable right here, you can see that accounts receivable is reported on my balance sheet now, what we call its net realizable value, or how much do we actually expect to get. So if I look at the way it's reported, again, I showed you this last class, but it's accounts receivable, as you can see right here, of 120, less the allowance for bad debts of 1,300, resulting in this net amount of 118,700. These are just made up numbers just to illustrate the way that it's reported. But if I think about what these things are, that $120,000 there, that's the gross amount of my receivables. So I am owed, as a company here, $120,000. 1,300 is the amount that I'm estimating that I'm not going to get, which means that 118,700 is the amount that I actually expect to collect. All right, so under this allowance method, not only do I match expenses with revenues, but I'm showing a more realistic amount for what I think I'm going to get from my customers, this net realizable value. All right, so there are three separate methods for estimating this bad debt expense: the percent of sales method, the percent of receivables method, and then the aging of accounts receivable method. So I'm going to shoot just a couple of videos for you today. Number one here is going to wrap up this video we're on now with this percent of sales method. And then I'll do a second video illustrating those other two methods, percent of receivables and aging, as they are pretty similar. So the percent of sales method, also called the income statement approach because it's based on an income statement number, sales, is just one of the ways that we can use to estimate bad debts. And percent of sales is actually the easiest method. It's actually the one that most companies will use when they're filing their quarterly reports with the SEC, just because it's a pretty quick and simple calculation to figure this number out. Percent of receivables is a little bit trickier, and then aging is the most involved, but it's pretty similar to that percent of receivables method. So let's start with our discussion then for percent of sales method. So percent of sales method, the way that we'll calculate bad debt expense with the percent of sales method is we simply take the current period sales, all right, how much were our sales for this year, and we multiply by a bad debt percentage that's given to us in a problem. So it's not something that we have to calculate on our own. If I was a real company, where I would get this from would probably be my past experience. So I'd probably look back and say, all right, last year I had sales of this much, I didn't get this much of it, so it was about 2%. All right, the year before it was about 2%. The year before it was about 3%. Right, so maybe I'll say this year, you know what, let's go about 2.5% just to kind of average out the last 3 years. I know that's not actually the average of the numbers I gave you, but a pretty good example there of how they would do it. They just look at what their experience was in the past, and then they'd use kind of that percentage, assuming they're an established company. If I was a brand new company, then what I would probably do is I'd probably figure out what my competitors are reporting with companies that are kind of like mine. I'd look at their financial statements and just kind of average out their numbers, and then I'd probably report something similar. All right, but excuse me, sorry. All we do is we take the current period sales, we multiply by that bad debt percentage, and the number that we get here is the number for our journal entry. And that's very important to make sure that you understand that, because sometimes when we move on to our future methods, the other two methods, that's not a true statement. The number that we get here is my estimated bad debt expense. That's what I'm calculating here. That means it's the number for my journal entry. All right, so let's look at an example here. So it tells me here that Baxter Company has credit sales of $700,000 in 2018. Baxter estimates that 0.5% of credit sales are uncollectible, and it just wants to know then what is bad debt expense for 2018. Just a heads up, if you wanted to record this one in your discussion guide, if you want to keep all your notes consistent and in the same place, this one is in that discussion guide for Chapter 9. So if you want to do that, why don't you go ahead and pause the video and grab that discussion guide out so you can record it there. All right, but I'm going to keep talking anyway. All right, so Baxter Company has credit sales, one more time, $700,000 in 2018. They estimate 0.5% of those credit sales are uncollectible. All right, so as we said, that formula then, all that we'll do to figure out bad debt expense is we'll just take 700,000 and we'll multiply it by 0.5%. If you have a percent button on your calculator, then you could type in 0.5%. If you don't have that percent button, remember, if I want to take a percentage to a decimal, I got to move that decimal spot to the left 2 places, which means 0.5% will change into 0.005. All right, so 2 zeros in front of that 5 if I was changing that 0.5% into a decimal. When I do that calculation there, I end up with $3,500 as my bad debt expense number. So again, as we said, in order to record this adjusting entry according to this allowance method, the entry is always the same, just how we get it can be a little bit different. But the entry, it's always a debit to bad debts expense, that operating expense account, and it's a credit to allowance for bad debts. So in this journal entry, I've debited bad debts expense for $3,500, and I've credited allowance for bad debts for that same amount, $3,500. All right, let's look at one more short exercise real quick just to make sure we got this percent of sales method down. We'll look at short exercise 9.6. So let me go ahead and pull that up right now. So short exercise 9.6 is in your textbook on, I'm not sure what page number I'm on here, 517 looks like. I have the ebook pulled up right here. All right, so short exercise 9.6 right here. It says, during its first year of operations, Fall Wine Tour earned net credit sales of $311,000. Industry experience suggests that bad debts will amount to 3% of net credit sales. At December 31st, 2018, accounts receivable totaled $44,000, and the company uses the allowance method to account for uncollectibles. So it wants me to journalize Fall Wine Tour's bad debts expense using the percent of sales method. So remember, we said with the percent of sales method, we just simply take our current period sales, all right, so in this case, $311,000, and we multiply by that bad debt percentage, or in this case, 3%. All right, so 311,000 times 3%. All right, I'm just going to pull that out here. So again, my calculation, 311,000, and then I'm multiplying it by 0.03. Make these numbers look a little prettier for you here. Oops, I guess I do need decimals on that one, sorry. All right, so when I multiply those through, 311,000 times 0.03 or 3%, that gives me $9,330 as my estimated bad debts expense. Again, that was just looking at that problem information back here from short exercise 9.6, 311,000 times 0.03. All right, so then to record that journal entry that I need to record here, again, this was on December 31st. All right, so at December 31st, for my date here, I'm just going to debit, same journal entry every single time, bad debts expense, and I'm going to credit this account called allowance for bad debts. So debit bad debts expense, credit allowance for bad debts, and I'm recording that journal entry for a total of $9,330. All right, this one wanted me to do one more thing here for short exercise 9.6. It wanted me to show how to report accounts receivable on the balance sheet at December 31st, 2018. All right, so remember, if I'm reporting accounts receivable on my balance sheet here, I'm just going to scroll over here to my next tab here, make it a little bit bigger so you could actually see it a little bit better here. All right, so if I'm showing accounts receivable, remember, first and foremost, we want to know if we're reporting accounts receivable here, which section it's going to go in. So I know accounts receivable is part of my current assets section. All right, so I'm going to say these are my current assets that I'm reporting here. And in my current assets section, I'd have cash probably listed before it, but I didn't know what that amount was. So I'll kick right down here to accounts receivable. All right, so I have accounts receivable, and if I look back at the problem info, it told me back here, right here, that accounts receivable totaled $44,000 at December 31st, 2018. All right. So I know accounts receivable was $44,000. All right, and then remember, right after I say less allowance for bad debts, and I know that my allowance for bad debts, according to that journal entry I just did, there was nothing in there from the previous period, told me this was the first year, so my allowance for bad debts is just that $9,330. And I'm subtracting it. I used that word less, so what I want to do is I want to make sure that I'm putting that number in parentheses, and then I'm just going to pull that net number for my receivables right next to it. So $44,000 less that $9,330 tells me my net accounts receivable balance is $34,670. So that is the way that I'll report accounts receivable on my balance sheet here for this company from Short Exercise 9.6. All right, so that's it for the percent of sales method. All right, I'll be coming back to you in 1 minute, and we'll be talking about the percent of receivables method as well as the aging of accounts receivables method. Thank you.